Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, August 3rd, 2024. How you doing? I hope you're doing well. I appreciate you coming to my weekend review podcast. Boy, what a week we had in the markets. The indexes really crashed down, all sorts of changes in structure in the markets. And I hope you're staying safe out there because the volatility has really picked up. And um, today I will go over all the indexes and kind of give you my analysis on where a bottom may be. But it's a very treacherous time. So you have to be careful. You have to position size based upon the volatility of the market. The market volatility is hugely increased, and therefore your position sizes need to decrease. But anyway, the format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades and positions that I had made last week. I'm going to talk about when I bought them, why I bought them, what the confluence of signals were, what the setup was, what the entry triggers were, and then, most importantly, how I am going to manage the trade going forward, whether it goes my way or goes against me. We'll talk about where I place my stops, my emergency stop, my end of day stop, or end of bar stop, and so fortunately, I had some good trades last week. But again, be careful because really you can feel the change in the market. It's palpable. So we'll take a look, see how those trades are doing. Then we're going to talk a little bit about trader psychology. Always the most important skill in trading is the ability to create a good plan, and then more importantly, to follow the plan. That's the key. And this week is um, the perfect example of sticking to your plan with all this volatility. But it's very important. It's the greatest skill in trading, the ability to follow your plan. So it's always helpful for me to teach this. I hope it's going to be helpful for you. And then after that, I have gone down through my watch list, both on the daily and the weekly timeframes. And I have identified some potential trades and some different levels for next week's on different markets. They're not where they need to be yet. I don't know if they're going to get there, but if they do get there, then I will consider taking the trades. Um, it's important to identify certain levels and wait for the trade to come to you. Don't go chasing it or don't just get in it without a signal. Overall, you're going to do much better if you identify something in the future and say, if it gets there, and then if it gets there, if you do take the trade, having a good risk to reward ratio. So I have some interesting ones. I hope it's going to be helpful. And if it is helpful, I would appreciate if you could hit the thumbs up button. It really would help. It really does help the channel, lets YouTube know that there's some valuable content here. So again, if you find anything of value in the podcast today, hit the thumbs up button and subscribe too. I always forget to say that. All right, so first of all, let's run the U.S. legal disclaimer and then we'll get started. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started with bonds. This is TLT. So I did enter TLT back here on the 25th of July. Why? Well, it was a deep dip buy, and in addition to being a deep dip buy, something I have noticed over the years that has been very helpful in my trading is when you have a golden cross, and a golden cross is when the 50-day moving average, the gray line, crosses over the black line, which is the 200-day moving average. When that crosses over, like you see it did here, when that crosses over, the first pullback to the 200, the black line, tends to be a very um, it, it it tends to bounce is what I'm saying. So you have the 50, the gray line crossing over the black line. The first pullback to the black line and rejection of the black line, which is the 200-day moving average, more often than not really tends to bounce. I've noticed that's always been a good entry. Now, a close under and close over the 200-day by itself, which is a deep dip buy, that's totally legit just by itself. But in addition to that, having the 50 cross over the 200, that's what makes this a better trade, because we're always looking for confluences, and that's the confluence under over 200 and the 50 crossing over the 200. So I bought it here at 92.27 with the close under and the close over the 200. So as soon as I get into the trade, the first thing I do is I place an emergency stop 2 ATRs below my entry. 2 ATRs below my entry. That's my emergency stop. Now, I only hit that emergency stop about 5% of the time. You've seen me do it, but it happens. But 95% of the time, if I have a losing trade, it's going to be my end of day stop. So why did I take the trade? Close under, close over the 200. Therefore, if it closes back under the 200, I'll get out. Even 1 penny, I'll get out of the trade. And that's the key. Being patient, waiting for your signals, waiting for the setup under over 200, after the 50 cross the 200, that's the setup, placing my emergency stop 2 ATRs below, and then having a very close risk to reward ratio. And I got in basically at the 200, just a little bit over. So this has been a really, really good trade, thankfully. So when I get in, I place a 1.5 ATR trailing stop level above my entry. So once I get there, if I get there, then I go into trailing stop mode, which doesn't mean I do anything. It just means now I'm in trailing stop mode. And what that means is now if I have a close below a previous bar's low in the future after reaching trailing stop level, I will get out of half. Okay, in addition to that, the end of day stop, the emergency stop, the trailing stop mode, these are all defensive moves. This is if something goes against me, but I also play offense on the trade, which means I take partial profits if it goes my way by a certain amount. And the amount is the value of 0.45 ATR. Right now it's 47 cents. So what I do, and this is what I'll do for Monday, I'll take the closing price, which is 98.28. I'll add 47 cents to that. That will be my first profit target on Monday. I'll take my first profit target, add it again. That will be my second. I'll take my second, add it again. That will be my third. And I do this every day. So I always have 3 limit orders in for whatever stock I have the position in. And if it moves up 0.45 ATRs, then I take 10% of however many shares I have remaining on that day. If it hits the second profit target, I take another 10% off, right? And so with this particular trade then, after I bought it at 92.72, the next day it did go up the 0.45. So I took 10% of the shares that I had remaining off. Next day moved up again, took 10%. Here, I don't think it did. Next day moved up. So every day, and then on Friday, which was a really, really big day yesterday, I hit 3 profit targets. So I'm scaling out, reducing my position size on the way up. So again, I think you have to play offense and defense. The defense, the emergency stop, the end of the day stop, going into trailing stop mode. The offense is taking partial profits as it moved up. So right now we're at 72.29. And so this trade becomes very easy. Now, if I close below the 70 RSI, I'm going to take off half of the remaining shares that I have. If that happens, then I'll get out of the entire amount if I get a close below a previous bar's low after rejecting the 70 RSI. So, I have many rules for trading almost 29 years, but there's a reason for every single rule that I have. Absolutely a reason for every single rule. And at first this may seem complicated to you, but it's really not. And by the way, if you would like to learn to trade like I do teach private one-on-one lessons in the evening time via Skype. I've taught students from all over the world. I think the best way to learn anything is one-on-one with your instructor. And in that course, I teach you all of the different trading approaches that I use, all of the rules, and I share everything I've learned over the last 29 years. So consider that, because I think you'll really learn a great skill and will really help your trading. In my emails in the link. So anyway, back to TLT here. This particular trade doing very, very well, up 6.12%. Next trade, gold. Okay, so this is a different approach. That the TLT was a deep dip buy. This is called a abandoned baby. And if you'd like to learn more about abandoned babies, you can go to my YouTube channel. I have a video on that. But I did enter here July 29th at $219.26. Why? Well, take a look at the little highlighted green box here. Do you see how we gap down? So for whatever reason, from previous day's close to the open, we had very bearish sentiment. But you see how the next day immediately we gap up? So we went from very bearish sentiment to very bullish sentiment very quickly. This is called an abandoned baby. So it leaves this little bar down here by itself. And that's why I like these trades so much, because if that happens and you look out into the future, more times than not, when you get this immediate down to immediate up and you look back into the future, more likely than not, it's going to be higher. Conversely, if you gap up and then you gap down and you look into the future, you're probably going to see some down moves like we did here. So I could have taken the trade on the right here, right then, when it created the bullish abandoned baby. But very often when you do this, you'll come back and you'll test the top of the abandoned baby, which is exactly what we did. So I bought it here on the 29th at 219.26. These particular trades are kind of set them and forget them trades. And what I do with this is I place a 2 ATR stop to the downside, and I place a 4 ATR profit target to the upside. So one of two things is going to happen. One, I'm going to lose 2 ATRs. Two, I'm going to make 4 ATRs. And in my experience, more times than not, it's going to move the direction that you want it to. And so in my experience, about 70% of the time, I'm going to make 4 ATRs. 30% of the time, I'm going to lose 2 ATRs. I do that all day long, right? Can you imagine if you flipped a coin and, if you won, you get twice as much as if you lose? You do that all day long. So it's similar. So Friday, I thought, boy, we may actually hit that, but we didn't quite get there. But so far, this particular trade is up 2.68%, which is pretty good on gold GLD. Next one, NVIDIA. All right, so NVIDIA is a entry that I took on Friday, and I got in here 107.10. So this is a little bit different of a trade, but you can see this long-term trend line on NVIDIA from this bottom to this bottom. So that's a trend line. And in addition to that, we have a bullish fair value gap here in the green area. And so this is another buyable area just by itself, rejecting the bottom of this fair value gap. But in addition to that, we rejected the long-term trend line. So that's why I entered the the trade. So I entered on Friday at 107.10, and I placed my emergency stop 2 ATRs below as always. My end of day stop on this particular trade is just a close below this trend line, because right now that is support underneath us. So I placed my 1.5 ATR trailing stop level above. So now if it moves up on Monday, for instance, and it moves up the value of $3.14, okay, then I'm going to take 10% off, right? That's the offensive part. And I'll place 3 limit orders in for Monday. On the downside, of course, if it hits my emergency stop, I'm immediately out. If at the end of the day it closes below this trend line, then I'm out as well. So I know exactly what I'm going to do regardless of what NVIDIA does. If it goes up, I'm going to take profits. If it goes down, hit my emergency stop, I'm going to get out. If it closes below the trend line, I'm going to get out. If it gets to my trailing stop level, then I go into trailing stop. So, if you know exactly what you're going to do, regardless of what the market does, it makes trading a lot easier. And also, I talked about position sizing based upon volatility. Folks, it's very important. It's very important. You have to take volatility into account. So, let's do this. So generally, I will risk 1% of my total capital on any one trade. And so let's just say I have a $100,000 trading account. 1% of that is $1,000. I divide it by the value of the 2 ATR, which is 1395, divided by 1395. That would tell me to buy 71.6 shares. So 72 shares, I'd round up. So if I have 72 shares and it goes down 2 ATRs, because I just did the math, I divided it by 1395, I place my emergency stop down here, then I know I'm going to lose $1,000, right? Worst case scenario, almost worst case scenario, it could gap below that, but most of the time I know that I'm going to lose just $1,000. But I know that's only going to happen 5% of the time. Again, 95% of the time, if I lose, it's going to be my end of bar stop if it closes below the trend line. That's my end of bar stop. And then of course, if it moves up, I'll take partial profit. So it's very important to always position size based upon the volatility and the value of your account, knowing where your emergency stop is, knowing where your end of bar stop is, how to take profits on the upside. And like I said, if it got up to trailing stop mode, then I have a close below previous bar's low. That's not a good sign, so I'll sell half. All right, so I hope that makes sense. So NVIDIA, I'm basically break even on this trade because I just bought it on Friday. So those are the 3 open trades that I have. Now let's look at the closed trades that I had. So similar to NVIDIA, I did get long on the Qs here on the 30th of July at 457.50. Why? Couple reasons. One, we rejected the 100-day moving average, and 2, we rejected the long-term trend line. Okay, so I placed my emergency stop 2 ATRs below, and my end of bar stop is simply going to be a close below the trend line. So I bought here 457.50. Now, this is a good example of why it's important to take profits when you have them. The next day, we rally hard. Okay, I hit 2 profit targets. So I took 20% of the position off. Well, next day, we had the big reversal. Friday, we closed below the trend line, so that I had to get out of the trade for a loss of 1.89%. But the key is that by taking the profits that I had here, it mitigated the loss, right? Because I made some profits on the 20%, now have a smaller position size. And so now if it comes back down, I've mitigated the loss, right? Because not every trade is a winner. So this particular trade closed below my end of day stop, didn't hit my emergency stop, but closed below my end of day stop for a loss of 1.89%. ARC. Oh, no, sorry. I did not have ARC. Why that was there. Okay, oil, USO. All right. I did get short USO back here on the 18th of July at 79.89. Why? Well, this is called a bearish fair value gap. This is the red area here. This is a shortable area. Why is it shortable? Well, we have this trend line here that we broke to the downside. This changes the market structure from an up market to a down market. And when you change market structure to the downside, very often you'll have a rally before it heads back down. Well, this is exactly what happened. And I entered, and now you can enter anywhere in the red box here, but I looked for, I wanted to be a little bit more specific and technical on my entry. And so I shorted here on the 18th at 79.89 with this bearish V1. V1 consists of two bars, bar one, bar two. Bar two goes above bar one's high, closes below bar one's low. That's a bearish signal. But on top of that, it was a bearish signal in an area, in a shortable area. So got short here, 79.89. I have my emergency stop 2 ATRs below. My end of bar stop is simply a close above halfway of the washout bar, which is right here, 80.33. So my stop was very, very close. And by the way, if you'd like to learn more about V1s, V2s, I have videos on my YouTube channel about it. Check it out. I think it'll be helpful. I use them all the time. Now, I place my trailing stop level 1.5 ATRs below. And of course, if it starts moving my way, I take partial profits. So the next day we had a big down move, took some partial profits, locked them in. Now I'm in trailing stop mode, which just means now if I have a close above a previous bar's high, I'll get out of half. Next day we moved down a little bit, took some profits. Next day we moved down a little bit, took some profits. Then we moved sideways, had a down move, took some more profits. At this point, I got into the low 30 RSI. If I get into the 30 RSI and then I have a close above a 5 EMA, I'm going to get out of the entire position. And that happened here on the 31st of July, got me out of the position. Unfortunately, it was still a 2.74% gain on the trade, which was good. But as soon as I got out, then we dropped. But that's how it goes. But anyway, so this bearish fair value gap did work nicely. And you can see that it's in, when I took profits here and here, much lower than where I got out. So again, good idea to take partial profits on the way down. It really helped because I locked in those profits at a lower price before it rallied. So USO up 2.7, close that out up 2.74%. WBA, okay. I did enter WBA. This is also a deep dip buy. I entered here on the 22nd of July at 11.29. Why? Under 30, over 30. We had a V1 entry. We also had a double bottom bullish MACD divergence. So nice setup. I placed my emergency stop here, 2 ATRs below. My end of bar stop is a close under the 30 RSI. I placed my trailing stop level up here. So I entered 11.29. Next day didn't do much. Next day didn't do much. Next day moved up, took some profits. Then it just kind of moved up, moved up, moved up. I took some profits there. I got to trailing stop level, which means now if I have a close below previous bar's low, I'm going to get out of half. That happened on August 1st when we have a close below a previous bar's low. I exited half for a gain of 4.23%. And then on Friday, I got out of the rest of the trade at break even. Why? Well, again, back to rules. If I have an under 30, over 30, and it gets to my trailing stop level and then comes back to my entry price, I exit at break even. So the remaining shares that I had after selling half on Thursday, I got out of half. And again, that's just a rule. That's the rule that I teach with my students and in my deep dip buy course. And if you've taken it, you'll know that that's what I teach, and that's exactly what happens. So anyway, good trade here on WBA, up 4.23%. So again, for the dailies, the open trades, TLT up 6.12%, gold up 2.68%, NVIDIA basically break even because I just bought that on Friday. Those are the open trades. The closed trades Qs, I lost 1.89%. USO oil up 2.74% and WBA up 4.23%. Okay, let's go to the weekly trade because I did have a weekly trade on McDonald's. I did get into McDonald's on the 12th of July at $245.90. Why? Well, on the daily, I marked the 200 week. So you can see the 200 week moving average. That's the black line here. I knew that was a key level. And on the day that I took the trade, I saw it go under the 200 week moving average and close back above. So this got me into the trade just a little bit earlier. I'm not trading it on the daily, I'm trading it on the weekly, but I got into the trade earlier on the daily because I saw the intra-week rejection of the 200. So again, I entered here 245.90, moved up, took some profits. Next week, moved up, took some profits, got to trailing stop mode. Excuse me, but unfortunately, I got out of the, well, not unfortunately, I guess in hindsight, unfortunately, but I got out of the trade for a gain of 2.47%. Why? Because earnings were coming. And I don't hold through earnings. And so I got out and then it raced up almost 10%. But that's how it goes, right? It could have gone down 10%, and so I would have been glad that I had gotten out. But I always get out before earnings. It's very important to get out for me before earnings. It's a great way to make a lot of money quickly, but it's also a great way to lose a lot of money quickly. And as traders, our main responsibility and our main job is to protect capital first. And if you concentrate on protecting capital, that's how you make the gains. But if you focus on gains, that's usually when you lose. So anyway, still a decent little trade here, 2.47%. Okay, so before we head on over and take a look at the possible trades for next week, let's talk a little bit about trader psychology. This is from my good friend Steve Burns. He was a teacher and mentor of mine, great trader, great author. You can check out his books on Amazon. But let's see what Steve has to say here. And you can follow him at @SJosephBurns over on Twitter. But let's see what Steve has to say. A trading loss is the cost of doing business. Your job is to keep them small. Look, if you're running any business, whether it's trading or carpet cleaning or, clothing store, whatever, as that business owner, you want to try to keep costs small. You know you're going to have them, right? If you're a carpet cleaner, you have gas, you have chemicals, you have employees, whatever. Every business has cost, right? I think we would agree on that. Well, trading is a business, and what are your costs in trading? Your losses, right? But like any other business, you want to keep your losses small. That's why it's very important to have a good risk to reward ratio so that if you're wrong, you can be wrong small. The biggest problem with trading is when you won't cut a loss and it just keeps growing and growing and growing and growing and growing. You're never going to be profitable as a trader unless you're able to take losses and just get out. It's never fun to take losses, but the smallest loss is the easiest loss. The first loss, excuse me, the first loss is the easiest loss. So you really have to work, if you're not able to take a loss, a lot of that comes down to ego. And you, ultimately, a lot of times you don't take the loss, it will come back, sure. But there will be times where by not taking that first small loss, it's going to bury you and really could lead to disaster. So, take it from me. I've been trading 29 years. I've been through all of this. And, if you want my advice, my best, caring, sincere advice is have that plan, know where you get out. For me, it's the end of bar stop or emergency stop. If they hit, I'm out. It's done. I don't argue. I don't try to make up an idea in my mind why this shouldn't be. I simply get out. It's much easier and more holistic way to trade and ultimately more profitable. So a trading loss is the cost of doing business. You're going to have them. but your job is to keep them small. So in other words, your job is to get out at the level that you decided before you got in the trade. So thank you very much, Steve. Appreciate that. All right, let's get over to the potential trades of next week. And then also, when I'm done with this, we're going to look at the indexes as well. Okay. So AGQ, AGQ right now is at an interesting spot. What I'm keying off of on AGQ, AGQ is double leverage silver, is the 200-day moving average. This is the black line here. If we come down and reject that black line, either intraday rejection, a bounce, or a close under, close over the 200s, similar with the bond trade that I show you, that might be an interesting spot. It doesn't mean it's going to be a profitable trade, but I do know that very likely buyers will come in at this 200-day moving average. And if it rejects it, then I know that the market has tested it already, and it means that it's probably less likely it's going to go under because the market just tested it. And in addition to that, you have the support of the 200 below you instead of above you. So again, doesn't mean it's going to be a profitable trade. You can get a rejection of the 200 and the next day it can just crash below, right? But we're just looking at probabilities and support levels. So, but the key is it's not there yet. And you know, when you have market volatility like this, people, if the market's really going down, people are going to sell all assets. You know, they'll even if you think silver or gold should go up during this, that it may not. If the market's going down strong, people just need to bail, get out of stuff, and that still may affect gold or silver. So don't be surprised. I wouldn't be surprised to see AGQ come down here to this 200. So that's what I'm looking for on AGQ. And look, if it bounces off the 200-day moving average, it doesn't mean I'm going to take that trade. And I guess this is a good time to mention that, look, here I have 8 symbols for next week that I'm looking at. They could all trigger on the same day. Does that mean I'm going to take all of them? No. I'm going to narrow it down to the best trade of that particular day. So Monday, if all these trigger for some reason, I'm going to go through with fine-tooth comb and go, I'm going to pick the one that has the highest quality score. And how do I determine that? Which one had the most confluences of signals? Maybe one bounced at the 200, another one bounced at the 200, but it had a V1 as well. Well, that would make that one better. So I look at confluences of signals, how it looks on multiple time frames, what the relative strength of that particular market is compared to the rest of the market in general. This is, the devil's in the details, and this is how I narrow down. And again, this is what I teach in my one-on-one course. Of course, I teach you all of the strategies that I use step by step and all the rules and all this, but I also teach you how to differentiate between multiple signals that happen at the same time on multiple markets and how to narrow it down to the best one. So again, just because it bounces at the 200 doesn't mean I'm just automatically going to take it, because one of these other signals I could have more confluences, more entry signals at the same time. All right, so AGQ for next week, bounce at the 200 potential. Caterpillar. All right, again, Caterpillar, what I'm looking at is at this 200-day moving average at the black line. You can see it is very close. It's kind of nesting here with the negative third ATR channel. 92% of prices tend to stop going down when they get to the negative third ATR channel. So the confluence here is the 200-day moving average and the negative third ATR channel. That's the confluence that I'm looking for on Caterpillar. I don't, we'll see what happens. But, next week, if it bounces at the 200 or intraday rejects at the 200, or I have a close under the 200 and over the 200, may potentially get me in Caterpillar. Doesn't mean it's going to be a profitable trade, but it gives me a good structure to go, okay, if it's above the 200, I'm in. If it's under the 200, I'm out. That's about as simple as it gets. And conversely, if it keeps going down, if it loses the 200, then I may want to pick it up, try to pick it up at the 250. If it loses the 250, I may want to pick it up here at the 300-day moving average. And at some point, if it goes low enough, we'll get into the 30 RS, the low 30 RSIs. And one of the best signals that you can have is a under 30, over 30 at the same time that you have a rejection of a major moving average. So if we get to the 200, I don't think we're going to get to the 30 RSI. It may take us to get to the 250, but who knows? I'll just have to see what it looks like. But I'm just showing you, the markets, potential markets that I'm looking at. So Caterpillar, rejection of the 200-day moving average, the black line would be my first potential. And I'll just have to see what that looks like. Or if it goes lower, 250 or 300 as well. Google. All right, so Google's coming into some interesting levels here. Back over here, we had this on earnings, we gapped up, and this created what is called a bullish market structure change and a bullish fair value gap. The bullish fair value gap is this area here that was never tested. This is the blue area right here. In addition to that, we have what's the green box is what's called an order block. An order block is the lowest bar close before market structure change. So here in the blue and in the green, essentially this is a buy area anywhere here. But you have to be the best place for me, I guess is what I'm saying, is the 200-day moving average, is the black line here, because that would coincide with the bullish order block. So you'd be in a bullish order block at the same time you're at a major moving average like the 200. So this would be a potential, and it would also give me a very well-defined trade, very good risk to reward ratio. Now, if we bounce off the bottom of this blue fair value gap, that would also be a potential entry. But the only thing with that is, what are you going to use as your stop? Because really the key stop levels are way down here. So there's a lot of range. So for the purposes of this podcast and what I'm looking at, what I'm going to say is, if we reject the bottom of the fair value gap, the bottom of the blue, so if it goes below and then closes back above, I would probably take that trade, and then I would use the 200-day moving average as my stop. But if it just heads down, doesn't reject it, and just goes down and rejects the 200-day moving average, I would almost certainly take that trade. I don't know if it's going to get there. Unfortunately, for it to get there, the market's going to have to go down a lot more. But for the purposes of this podcast, if we reject the bottom of the blue fair value gap, I would definitely consider take the trade. The 200 would be my stop. If it just heads down, doesn't reject it, and then rejects the 200-day moving average, which is in the bullish order block, then almost certainly I would take that trade. So that's what I'm looking for on Google. Russell 2000 IWM, kind of similar. This blue box here is the bullish fair value gap, but I'm not going to mess with it here because the stop's so far away. So what I'm looking for on IWM is the bottom of this blue fair value gap. If we go down, reject it, then I would potentially get into the trade. My stop would be a close below this bullish order block here. Low is $200.53. I hope that makes sense. So if it goes down and rejects the bottom here, 203.79, it rejects that bullish order block, then I would get long, and then my end of bar stop would be a close below $253. If it does not reject that bottom of the order of the bullish fair value gap, and then comes into the bullish order block, which is this green area, ideally this would be better because it's lower and it's closer to my stop. So essentially I'm looking for a rejection of 203.91. If it rejects that, that may be an entry. If it doesn't reject that and keeps going lower and then rejects this bullish order block somewhere here between 202.04 and $200.42. That would be a very good entry point with a very good risk to reward ratio. Microsoft, MSFT, wow. Well, we are right there, aren't we? We got very close to bouncing at the 200-day moving average. The black line has not done it yet. But on a stock like Microsoft, usually more times than not, when you have a rejection of the 200-day moving average, it's a pretty decent place to buy Microsoft. It doesn't get there very often. Well, folks, it's there. Look at this straight up, straight down. Isn't that something? So what I'm looking for potentially next week on Microsoft would be an intraday rejection of the 200-day moving average, close under, close over the 200-day moving average, or a bounce. That would get me potentially interested in buying Microsoft. But again, just because it does that doesn't mean I'm going to take it, because I have these other 8 to choose from, which may be a better setup. QLD is double leveraged Qs. So it's double leverage. It's going to move for or against you twice as much. We are getting very close to the 200-day moving average, which is really incredible. It's being that a couple of months ago we were up this high. I mean, we've gone from an 80 RSI to low 30s in one direction. So QLD, potential bounce at the 200-day moving average, intraday rejection of the 200-day moving average, or close under, close over the 200-day moving average would definitely be a potential entry for me on QLD. QQQ, regular Qs, okay. What I'm looking for here, and I think this would probably be a pretty good confluence, is, look, we have the 200-day moving average down here that coincides with the 6th ATR channel, which is incredible, because the 6th ATR channel, usually if you get to the negative 6 ATR channel on about any market, that's pretty close to the bottom. But in addition to that, we have this long-term trend line, very long-term trend line, comes back here from 2023. If you connect the bottoms out into time, you can see that this would be a long-term trend line, and there'll probably be some buyer, some support. But again, this is $15 lower than where we are at the moment. So, who knows? Right now, it's kind of a no-go zone. We are at 35.29 RSI. So I guess I should mention that there's another potential deep dip buy signal next week. If we go under 30 and over 30, that could be a potential entry as well. And that would probably happen higher than the trend line or the 200-day moving average. So what I'm saying here on the Qs is, we've had this huge sell-off, but we are coming into some supports, again, at the 30, potential rejection of the 30 RSI, potential rejection of this long-term trend line, or potential rejection of the 200 days. So I guess if I drew this box a little bit more accurately, I would say somewhere in this area of 440.80 to 430, this would probably be likely to be a bottom for the market. Again, it could go much lower. I don't know, but just technically, these areas here are what I'm looking for potential, at least short-term or intermediate-term low. A rejection of the 30 RSI, a rejection of this long-term trend line, or a rejection of the 200-day moving average. Last but not least, Tesla. Okay, so you remember the TLT trade that I showed you at the beginning of the podcast. Look, this is what's happened. Remember I said if the 50 crosses over the 200, then if that happens, the first pull back to the 200 is generally a pretty good entry spot for a potential nice bounce. Well, the 50 has crossed over the 200, definitely. And look, we're almost coming back to the 200-day moving average. Doesn't mean it's going to bounce at the 200. It could blow right through it, obviously, and then it changes it changes everything. But because the 50 crossed over the 200 and we are coming back to the 200, Next week, if we do get a rejection of that 200, well, then I would potentially take that trade. So those are the potential dailies that I'm looking for next week. Don't know if any of those are going to get to where they need to be, but if they do, I'll consider taking the trade. And let's head over to the weekly time frame. And I've just got a couple here on the weekly. AMD. Okay. Well, AMD down a lot this week, but there are some potential buy areas, and I don't know if they're going to get there, but the first potential buy area on the weekly bars would be the 200-day moving average. That's a simple deep dip buy approach. And again, it doesn't mean that if it rejects the 200, it's going to go right back up. I don't know that at all, but all it does is that it gives you a good structure to base your trade off of. Above the 200, I'm in. Below the 200, I'm out. That's simple. In addition to that, you see the blue box area here. This is the bullish order block. The furthest down bar close before you had market structure to the upside, there should be some buyable. You should get some type of a bounce in that bullish order block. Not for sure, but very likely. So again, it's kind of a wide range. And again, I don't know if it's going to get down here, but if it does get down here, I think that would be it would at least give you a very good risk to reward ratio with rejections of major levels like the 200-day moving average or the bullish order block. But again, it doesn't have to hold here, but it gives you a good structure. So that's AMD on the weekly, and then Amazon on the weekly. Well, yeah, look, we had the 50 cross over the 200. When that happens, what do I want to look for? The first bounce of the 200. So the 50 weekly crossed over the 200, giving it a bullish. It's called a golden cross, but the 200 that would be where I would be interested in buying it. But the 200 is 145.65. It's still a long ways down there. So, likely is it going to get there? Probably not. But if it does, that's what I would be interested in on Amazon. But highly unlikely that that's going to happen. But if it does, be a good potential trade. So let's look at the indexes in general. And well, we kind of already did Qs, but let's do it again. I guess kind of what I want to show you here is, looking back in the past, what were the telltale signs that something was happening? Well, this is pretty simple. Look at this long-term trend line that we broke. That was it. When we broke that trend line, straight down. Okay. I didn't short here. I would wait for a pullback or a check back, but it never happened. But in hindsight, of course, everything's very clear. We broke the 200. We broke the trend line. This happened. Now, the other thing that happened is that we had this other trend line here. We had another trend line. See how we broke that trend line as well? As soon as we broke it, look, we went back up to it and failed at the trend line. So very often when you break a trend line, you will go back up to it before it heads back down. And again, I took that trade on the 30th at 470, 457.50. Why? Because it held the trend line. Okay, but now we've lost that trend line again. So now that we've lost this trend line, yes, certainly we could rally, but if we rally back up to that trend line, that is going to be resistance. Okay, you see bearish fair value gap here in the red. It's exactly where it got and then failed. So moving forward here, what do we do? Well, I guess I should say two things. We are going to have some issues rallying back up because we have this trend line above us that will most likely act as some resistance. If we move past that, we still have this trend line here, this previous trend line. So I am really quite bearish on the markets right now. It's going to take a lot to recover these levels. And yes, we certainly could bounce. We're extremely oversold. We could bounce, but I don't think those bounces are going to have a lot of legs to them because of the resistance above. So again, I just talked about this on Qs, but there are some support levels below. We have the trend line here at at 435. Again, that's 13 points below where we are now, but that should theoretically add some kind of support. And we also have the 200-day moving average as potential support, and we also have a rejection of the 30 RSI as support. So that's again why I drew this green box, probably somewhere between 440, 45 to 428.94. This, I feel pretty confident, barring some kind of war or something like that, that this probably would be a short-term low in these areas between 440 basically and 430 basically, 440 to 430. But still, that's 8 to 18 points below where we are, and that could certainly happen. Okay, let's take that. Those are the cues. Let's take a look at the SPY as well. Again, let's look back in time. Look, we have this trend line that got broke. That was it. Then we had the secondary trend line here. We failed that one too. But at that one, we rallied back up. But again, we rallied back up to that trend line, which is now resistance above, and failed dramatically. Not only did we have the resistance of the trend line above us, we also had the bearish order block, which is the red area. I do some consulting with a hedge fund, and we had our discussion on this day, on the 30th, and I said, I would probably be looking to short any rally, and you can see I drew this little beige box here because that was a confluence of being in the bearish fair value gap and also having the resistance of the trend line above us. And I mean, it's exactly what happened, right? Next day we rallied, and I was thinking, that's probably where it's going to fail, and that is exactly where it failed. So we've lost this trend line, we've lost this trend line, we have now lost this trend line. These are all going to be resistance above us if we rally back up. But to the downside, we have a long-term trend line here about 515, but still that's 17 points below where we're at. In addition, if we come down and we reject the 30 RSI, that could be a short-term bottom. But we also have the 200 way down here. Oof, be scary, right? If we got down to there. So right now, for me to be interested in getting along the SPY, it would have to be at least an under 30 over 30. Usually I don't take under 30 over 30s just by themselves. There has to be some kind of other confluence. But with an index like the SPY or the Qs, an under 30 over 30 is enough for me to get in and take the trade just with that. The best thing that could happen is that we move down a little slowly and we have an under 30 over 30 and rejection of that long-term trend line. That would be an ideal spot. And, I would think somewhere between 518 and 513, I'd be pretty confident that would be a short-term low. But again, it could go lower. We could go down and test 500. So a lot of things going on here. And of course, if we got down to the 200 down here, that would be something as well. So those are the markets. But I guess what I'm really trying to point out, both on the SPY and the Qs, are yes, there are some levels below us, potentially. But more importantly, to the upside, there is a lot of resistance above us with fair value gaps and these long-term trend lines above us as resistance. So anyway, I hope that was helpful. Like I said, if it was, I'd appreciate it if you could hit the thumbs up button. If you'd like to work with me, I do teach private one-on-one lessons in the evening time. I've taught people from all over the world, from absolute beginners all the way up to the hedge fund level. The course is 15 hours long. We have 5 sessions. Each session is 3 hours. And I teach you all the strategies step by step. We do a lot of simulation. I throw a lot of curveballs at you. By the time you're out of that course, you will know these like the back of your hand, and you'll have a real skill. The course does cost $1,750, but trust me, that it is worth way more than that. It's worth every single penny of what you're going to learn and the ability to work one-on-one with your teacher. So if that's of interest, my email is in the description. Just send me an email and we can start corresponding. Secondly, if you like online courses, I have a very affordable online course, Deep Dip Buy. We've talked about Deep Dip Buy a lot today. That's available at udemy.com. The link is in the description of this video. It costs somewhere between $30 and $50, but it's a great course, 9.5 hours of video. And I teach you step by step how to trade the deep dip buy approach. I've had so many good reviews on that, like 4.8, 4.9 out of 5 on that course, and have people from all over the world that bought that and such good reviews. So, as a starting point, that's a great place to start. All right, and then watch for my videos during the week, some day trading videos where I go in and show you the setups. And if you find those helpful, let me know. I'm trying to do those to show different trades, different days. Here on this podcast, it's during the their daily trades, their weekly trades, but the same stuff works intraday as well. And so. Anyway, that's it. I always like to leave off with, please try to go out and do something nice for someone today. Really, it would make the world a better place if we all could do one nice thing for another person. If you could do something nice for an animal today, that would be twice as good. Animals appreciate act of kindness just like we do. But I appreciate you being here, everyone. Please stay safe out there. Market has really, really changed. Be patient. Wait for the setup. Position size correctly, and by all means get out if your approach tells you to get out. All right, but if you have questions, put them in the comment section. I'll do my best to get back. But anyway, have a good rest of your week. Be careful next week, okay? Thanks a lot, everyone. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.